right, good morning, everybody. I'm just so off today. It feels like Wednesday, so somebody needs to fix that. Other than that, it's a good day, right? It's a good day. They are starting the FOMC meeting today. It lasts for 2 days. We'll get the results tomorrow afternoon at 2 o'clock, and then Powell will come out chipping his teeth at 2:30. If you want to see what's the current projection on that, you can Google Fed Watch. And you get this CME Fed Watch tool. Today is not really going to be that useful for you, but going forward, right, for the next meeting, for an example, December 13th. So it'll let you know when the dates are. And then you can also click on those dates and see what the projection is at that time. That way, when you hear the phrase, oh, it was already priced in, I'm sure we've all heard that at some point, you'll understand what is priced in and how they knew it was priced in. Because when I was new to trading and I would hear people say that almost like an excuse, when I'd ask a question of how come it went down, I thought it was going to go up. How come it went up? I thought it was going to go down. And they'd say, oh, it was already priced in. Well, how did you know that? And what was priced in? So when it comes to the FOMC, we're thinking about rate hikes and whether those rate hikes have been priced in, whether the unwind, if they start to cut, which, we're nowhere near a cut, but if they were, we could see that it was being priced in, that the market was unwinding those positions for a higher and longer rate, or if they were adding to it on the assumption or the belief that they were going to raise rates, we could see them pricing that into the bars here, where the probabilities will increase or decrease, right? So just to make it not confusing, right? You want to try to keep it as simple as possible. Just think of only one of these numbers. You don't need both. You can use the 550 or use the 525. It doesn't matter. And if you do, then you've only got one number, 525. And what's the current projection for December? That we're still going to be at 525 with a 71% probability, which means that the current rate that we have now, and we're going to be reporting on tomorrow, is going to be the same thing that we'll have in December. So still this pause. They're not pricing in a cut. They're not pricing in a hike. They're just continuing with this high for longer, not higher for longer. That phrase is done. That implies that the Fed is still going to continue to raise rates, which they've kept in their pocket. They have said they are willing to raise rates more if needed, but until they saw something that said they needed to, they didn't plan on doing so, right? So it's not higher for longer. It's just staying high for longer is the plan. A lot of people believe that they're just going to keep it at this level until something breaks, that they have no plans on a rate cut at all until they break something. On one hand, that's not necessarily a bad idea. On the other hand, the tools that they use are so lagging that by the time they do start breaking something, it will be beyond the point where they should have already been cutting, and they'll be behind the ball again. But what can you do, right? It's not a perfect world. Japan came out with news yesterday on the yield control. Things are changing on that front, but remember, we've got a new BOJ governor, and this new guy, while he said that he favored the same system that the old guy used, now that he's boss, he can do what he wants. So it's worth keeping your eye on Bank of Japan and the news that's trickling out of that. Take a look at what's going on around the world. Hong Kong is down, and everybody else is up marginally. Japan is up the most, 1.22, just call it 1.25. And then Europe and the UK. Then we got the Russell, the Dow, the S&P, and the least of all, the NASDAQ. Now, when you think about this progression or this order of importance, and why do I go through it, right? Like, who cares? They're up, we're good. But up by how much, and who's up and who's not up? The NASDAQ, big tech, I mean, that is the market, right? That's the market that continues to push us to the upside anyways, when times are good. And it's the market that takes us down when times aren't so good. So we really want to see those FANG names, those blue chip monsters of tech companies, making gains. When the NASDAQ is the least up out of all of the indexes for the US, then we already know right off the bat there's something wrong with the Magnificent Seven or the FANGs. So you want to take time when you're doing your morning briefing, when you see this, to deviate and go take a look at the FANGs and make sure it's not just, say, one particular name taking everybody down. Say like Tesla with deliveries, those delivery numbers can knock Tesla down and that can take the FANGs down. Or say Apple with its new M3 chip. We never know. That's why we want to go take a look. Because if we're going to get a really good rally on a day, it almost inevitably comes back to the FANGs helping us out, right? So it's really it's worth the extra legwork to go figure out what's up with the NASDAQ when you see it lagging the group. And then on the other side of it, who is leading? Well, it's the small caps. So dash for trash, penny stock, junk, short squeeze. And a short squeeze can, if you look around, how many things are beaten down that have the potential to be forced into a squeeze. That's a pretty big list. So this can engage a broader group than we would care to admit, right? The Magnificent Seven names, really easy to keep track of. The Russell 2000, and there's a lot of names in there that they're like Joe Schmo lawnmower company, something we don't know. I don't know half of them, right? Not even a quarter of them. They're just zombie penny stock trash companies. But you get enough of those squeezing, get this sucker moving. It's worth taking a look when you see that it's leading to find out what inside the Russell is causing this to lead. Is it a particular industry, say like pot, or Bitcoin proxies, cryptocurrency companies, things like that, blockchain companies? It's worth the extra legwork in the morning to see what is moving the indexes the most, to kind of point you in the right direction for the kind of trading day that you're looking for. Remember, these morning briefings, as much as everybody wants my outtake on this or outlook, I do these to teach people how to do a morning briefing for themselves, right? Because I might not cover what you want covered. You might be a penny stock trader and don't like it when I call them trash. Kudos for you. You have fun with it. We got a lot of data this week, and it's all really getting overshadowed by the FOMC. But individually, the data that we're getting still has a lot of value and a lot of merit to it. So we're getting ADP employment on Wednesday, same day as FOMC, and that's usually a pretty good one all by itself. The fact that we're going to get it tucked in with FOMC just kind of reiterates the idea that this week is going to be a difficult trading week. And if you're already struggling to be a consistent trader, not trading this week would be your best bet. And I know nobody wants to hear that, right? You didn't learn how to trade just to sit out and not trade. I get it. I totally understand. But weeks like this can mess with your head, make you think there's something wrong with your system or something wrong with your approach, when really there's nothing wrong with what you're doing. It's just doesn't fit the environment that you're trying to do it in, like this week. I know a number of traders who go on vacation during FOMC weeks. It's the perfect time to get away from the market because you're not going to miss anything. But Friday, non-farm payrolls actually carries a little more risk to it than FOMC does. That's something to ponder on. We already know what FOMC is. It's not a surprise. We know what's going on there. What we don't know is these job numbers. Something to think about. Here's the projected impact of the various economic events today. And as you can see, there's a lot of them scattered all over the place. And it started earlier this morning in Europe. Bank of Japan tweak. So as I mentioned, they are making some changes, but according to this article, it was a modest adjustment. I like how they put that. It was just a modest adjustment. So everything that comes out of Japan is worth a read, especially when it's connected to the FX markets, right? I know it seems like a lot of reading, but you can use things like Upward and other AI platforms, feed it that article, and it'll cut probably 80 to 85% of the article off, right? And feed it to you in like 5 sentences. So you get a really solid summary without having to read the entire article. Speeds things up considerably. All right, so we got the dollar here. And sure, in the grand scheme of things, we're well off of those 115, 120 areas, but you put it on a weekly and you can see this consistent move since June and how we're just digesting up here. As long as we continue to hold this range, this is still bullish. All right, we have to break this zone, either get out of it or, we can't just stay here. And the longer we stay here, the more bullish it is. Or IX10 on a weekly. So 105.5 is a nice line in the sand. We need a weekly close up below that level. $107. If we get above that, then we're going to keep it and very likely will continue into, we'll call it that 50% mark back here, right? 50% of this very large candle. That'd be 108.77. All right, looking at the 10-year for Japan, you can see how just out of control this looks. You see why the threat is real. It's worth taking a moment to recognize the danger here. And US dollar Japan. $105.77 is the high that we got to last week. We got very close to that again this morning. In October of last year, we can see that their intervention at 151.94. Now, look, just because we get to that spot doesn't mean they're immediately going to trigger an intervention. For a number of things, this intervention wasn't done just by Japan by itself. They had help globally. You know how inefficient the government is, right? What's the old phrase? The most dangerous thing you can hear is, "Hi, I'm from the government and I'm here to help." So they're just going to screw it up. Well, tie multiple governments together and have them all trying to accomplish something. Yeah, good luck with that. They managed to get it right last time, but it's not like they can just reach out and hit the button, right? It's going to take effort and coordination. The thing is, we're past the level where they have made that decision last time. So I don't know that they're going to intervene just as soon as we get to this level, but the threat of their intervention continues to loom. And it has to weigh on you. If you're short, this is your biggest threat. Hands down. There's nothing else right now threatening your short position as much as this does. All right. Bonds are up considerably this morning. That's a good thing. It's really going to help out, especially if we can get stocks and bonds moving together. And generically, stocks, quote stocks, is just the indexes. You get the S&P and NASDAQ moving to the upside with bonds also moving to the upside. It'd be a good thing. TNX isn't open yet, but we can use something like the 10-year. It's the 10-year futures. So we can see the 10 years really sold off this morning. We got the dollar really sold off this morning. And this move, notice it matches with the ES, which was in a consistent, persistent sell-off while the Dixie was making this aggressive move up. And then we got this really cute little head and shoulders there. And the Dixie went down, the S&P went up. We found some support. We're kind of digesting at this level. And we're at resistance here in the ES, yesterday's high. So, you know, the idea or the theory here is that we get the Dixie breaking down below this Globex low. Then we get the ES breaking out above yesterday's high and continuing to move higher. Just remember, our bias this week was that we were going to hold the line into FOMC. We would sell into strength. We'd buy into weakness. The megaphone pattern exists because liquidity resides on the other side of the pivot. So when we get to yesterday's high in the ES, for an example, we're very likely going to break through the high of yesterday and go beyond it at least a little bit because liquidity is on the other side of it. And then we reject and we fall back in again. It's interesting to note that while we're in this quote low volume environment, while everybody's waiting on FOMC, the volume is sitting at 128 this morning, and that's not so low. That's a good average morning. Here's our numbers for today: 8:30, 9 o'clock, 9:45, 10 o'clock, 11:30. So we do have additional auctions. The 4-week is right up front. You can look at something like the IRX. And then the 52-week bill auction. But we've got 128 in the volume this morning, and we don't have hedging. So they're trading, and they're not protecting themselves through some sort of hedging, showing a lack of fear. The 42.11 is a close level from last week. It was Wednesday's close. It's also part of this gap that still hasn't filled. It's an intra-week gap. We don't see too many of those of this size that last for this long, but it's still there, needs filled. So if we get through Thursday's high, that's the target, right? Now that's only a 6-point move, but those 6 points with 10 or 12 contracts, yeah, that's day done, yo. We're good to go. Go make some cookies after that. All right, so it's something to consider. Then when we get to 42.11, which happens to also be a cog line, it's not just a gap close. It's not just a daily close, it's also that cog line. You got a first touch rejection play that could very likely send you right back down to Thursday's high. So another 4-point play in the other direction. 10 to 12 contracts, might as well get 2 weeks worth done. Catch a mortgage payment. We're back above the weekly pivot point so far. We got there yesterday, but we weren't able to keep it. Usually takes a little bit of a struggle. Just for context, here was the weekly pivot point from last week, and we never got to it. We just continued to trade away from it, which brought it down here. That's a pretty good size move for a change in location from one weekly pivot point to another weekly pivot point. Either way, we're above it this morning. We really want to keep our eye on it and see if we're going to actually keep it or not. And yes, we did hit it and reject off of it yesterday, but there was something else there yesterday. And I don't really think it was the pivot point that we hit, right? I really think it was the ADR level. This is that same spot that we were talking about. Kind of helps if we have the shading there to see it. So whether it was the ADR or the weekly pivot point, or, it just stack them up, there was enough resistance at that level that it couldn't have been too much of a surprise that we actually rejected off of that 4180 area. We still do have all of our moving averages to contend with, and we have that weekly half 4206 to deal with. So any continued move to the upside has to focus on 4206. Then we've got those 50-week moving averages, and then the 10s and the 20. If we fail to break out today, it's very likely that the point of control will be down in this 4180 area. Otherwise, if we advance today, break through that 4200 and start moving towards the point of control, we're just going to reinforce that point of control's level. It gets really shallow above that 50%, so we don't have a lot of resistance to cut through. There's no classic shape here. We don't have, our regular alphabet to choose from. When we're at the high, we expect to go to the lows. When we're at the lows, we expect to go to the highs. All right, I mentioned I was going to carry forward that point of control yesterday, that it wasn't a VPOC anymore. It was just a POC. And we actually spent so much time there that it became a point of control. See, that was Monday. It became a point of control for Monday. So we're going to take it off. That was Friday's point of control carried over into Monday. We spent so much time at that level that it became Monday's level as well. So we'll get that out of the way. We'll put a real VPOC level there. $41.61. And we do have these old levels from a long time ago in contracts that we no longer have. This is a little bit of a change of pace. It's the first VPOC underneath us that we've made since we've been falling, right, for a while. We put it out here on the daily, kind of consider, these VPOC levels. You can see how far back these old ones are. March, April, May. Actually, I would say not May. They're all tied to this time zone right here. So that's like multiple contracts in the past. Just round up, keep it easy. 41.62. It's kind of our line in the sand right now. It's what we want to focus on for any downside move. Pivot by pivot, we'll get back to our own current pivot point, point of control. It'd be yesterday's close, the POC, the Globex low, the RTH open of yesterday, and then this VPOC, yesterday's low, Globex low. Right, and that's if we continue this move to the downside. Otherwise, we're going to focus on 42.11, 42.06. Those are the two pivot points to the upside of concern. We cut through those, and we'll focus on the RTH open of Wednesday of last week, and this 42.50, which optionality, that's got a lot of structure to it. 42.50. All right, we're 0.75% away from the 10-day moving average. We're moving back towards it. You can see how the curve here in this wave. And just because we get back to that 10 doesn't imply really too much of nothing by itself. I put the 10-period moving average here to kind of give a more visual representation of what we're focused on with this indicator. We're measuring how far from the 10 we are. So you can see how we drove back towards the 10 and we never got there and continued lower. So just because we're moving towards the 10 doesn't necessarily imply we're going to get there. And we are still focused on yesterday. And this is that Wednesday's gap close that I was talking about. There is the upper edge of the weekly expected move at 42.13, which is really close to that 42.11. So another reason that we would consider this resistance an area of concern, a difficult zone to get through. We're 2.5% away from the 10-week moving average. We are coming back towards it, but we got below 4%, right? We were more than 4% away from the 10-week moving average. So sure, we're working our way back towards it, but we still got a long ways to go. We got the beginnings of a trade setup here that I've been focused on more and more lately. And I just thought it would be a good time to kind of lay it out. So this is not a fib that I just snapped here. It's just a quant level. These are quadrants, 25%, 50%, 75, and 100. So there's a trade that I really like that focuses on the halfback. And this setup works everywhere and anywhere. So tick charts, minute charts, hourlies, dailies, whatever. Measure the impulse. You got your 50%, call it the halfback. And we're looking for a halfback test. So if we test against that and it holds, we target 75%, this next quarterly level. That's your target. If we break the halfback and we continue to the downside, it's called a halfback break. Simple enough. We target the next quarter. Now, sure, we could get all the way back to the bottom. We could get all the way back to the top. But in the trade, just focus on the next quarter. Obviously, the smaller the zone, the smaller the entire impulse, the smaller the distance between the quarterly level, right? So the bigger the zone you measure, the bigger the level, the more room there is. But this is a halfback fail. If it gets here and bounces and goes back up, that's what I call it, a halfback fail. If it gets to the 50% and breaks through, then it's a halfback break. That way, when you go to journal it, you're able to label it in your journal, and then you're able to search for it, keep track of your trade results. How often do you trade the halfback? How often does it work? Blah, 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 right? Kind of give you the same concept here, was the exact same thing. So, you know, we could have been focused on this impulse. It didn't quite get down to 50%, so a halfback fail. But even with that one, since it didn't get down, there wasn't really enough there to trade it on this chart's time frame. There was another one here. Once it got to that level, you would have snapped it. Once it started moving in this direction, you would have been looking for a halfback fail to see if it was going to continue to the downside, which it didn't. It broke through it, went to the next level, to the 75%. Of course, it went all the way to the top. On this time frame, that doesn't look like much of a trade, but it is still the same trade, right? Measure the impulse. There's your halfback fail. There's your trade. You actually got two chances to do it, although, you know, you got to kind of realize that sooner or later it's going to break the zone. But you still had another one. And then when we finally did get through it, got through the 75%, then we were able to target this as a trade. I don't consider that a trade unless you'd already taken it off of the low. So something to think about if you're not already using quadrant lines, if you're not already focused on a halfback play, that it's not a bad approach. And as always, anything that you do to personalize a trade style to make it more uniquely yours, the more effective you're going to be able to trade it. So I'm just pointing out the value of the 50% line as if you haven't seen me use it enough already to begin with, because we're constantly focused on that 50% mark. This is just another step in using the same level that we already use, just using it a little bit more. You can find value in that 50% everywhere. All right, the China constituents through KWEB is down more than 1.75%. Bitcoin down more than 0.5%. It makes sense that we're seeing silver and some precious metals down as well, with US dollar Japan making that advance to the upside. Just keep in mind, we continue to talk about the intervention and its effects on the S&P and the NASDAQ. It's going to be, well, it's projected to be pretty impactful on precious metals too, right? When US dollar Japan falls, precious metals, gold and silver and such generally move up. They also generally move up into an FOMC event and then dump afterwards. So the fact that they're going down as we near FOMC is a little bit of a surprise. Even with US dollar Japan going up, they tend to buck the system and go up during FOMC. Now that's something that I did not know about, right? I learned that from somebody much smarter than me. I didn't see it in the charts, right? Maybe you could see it in a seasonality chart if you were to look at FOMC and gold. So I've never done the correlation, but I've seen the effects, right? And if you go back and look at FOMC and look at what gold and silver were doing, they generally rise up into FOMC, which is a really interesting concept. I just don't understand why. But we're not seeing that this morning. We're seeing them down with US dollar Japan rising. So if there is an intervention, they are very likely going to make sharp moves to the upside. And I bring that up because I don't want people thinking, oh, well, I'll just go short silver and precious metals. And yeah, approach with caution. There's a couple of reasons to believe that they could make some substantial moves to the upside through FOMC itself, and or if there's some sort of intervention out of Japan. Uranium is leading the most this morning, up 1.5%, but behind that we have the pot stocks. We're using MSOS, a bit of an ETF for marijuana. Then bonds behind that, and another ETF, Alternative Harvest. It's MJ. Another pot, it's up 1%. Crude behind that, or USO, United States Oil Fund. And then the small caps, but then we get below that 50% threshold. A rally based on pot stocks and uranium is not a sustainable rally. This does have the potential or the threat of a short squeeze. And we've seen short squeezes that just propel the markets much farther than we thought they could go. So, treat those with some caution and respect, because they might be penny stock trash, but it bleeds over, right? That kind of antagonistic approach to trading, it kind of bleeds into other markets if it continues to advance really high, really fast. Well, it looks like they finally made this public. Spot Gamma had been laying out this argument about these vol sellers using Friday and Monday. If you haven't heard this concept yet, check out Finance Juice, where it says, why has VIX been dropping on Mondays? It's by Spot Gamma, and it looks like it's a public YouTube page. Now, I've already been kind of up to date on that because, I've got Spot Gamma, so I got it off the website, but they made it public. And even if you don't use Spot Gamma, catching this logic of what those vol sellers have been doing with the Friday trade for the, well, they get in it on Friday and Monday is the outcome. But yeah, take a look at that. It's worth it. Speaking of spot gamma, let's just go ahead and get those levels. And happy Halloween, by the way. I live on a like a cul-de-sac, or a dead end road, so we never get trick-or-treaters. So after a while we just quit decorating the house, but I miss it. Miss putting up the decorations and doing the trick-or-treat thing. It's boring and sad when the kids grow up and move out, right? The grandbabies are too far away to see them all dressed up for Halloween. Maybe I duck out of here early today and go see them anyways. Call wall 4,500. This is updated. If you are going to use spot gamma, always make sure that it has the current date. Depending on which one of these we jump through, that date might change. It didn't, but you never know until you look. So 4,500 is the call wall, and that's a long ways off. The vol trigger is 4,280, zero gamma 4,270, just round it, right? Easy numbers. So as long as we're underneath those levels, we're considered in a bearish complex. And the put wall at 4,100. So we are going to consider that some sort of support, that if and when we go down to a 4,100, that we would find support there. And if that happens to be over our head, then when we get there, it's likely to be a resistance, right? Because you will find times when it's over your head and it's still considered the put wall. So it'll be a resistance if we come into it from below. It'll be a support if we come down into it from above. For the ES, and I shouldn't say this, but when it comes to the ES, I don't lean much on the optionality values, other than recognizing when we're in a market maker move or not. So the call wall, the put wall, all of those have less weight in my analysis. But either way, whatever. For SPY, 410 on the put wall, 417 for the volatility trigger, zero gamma at 424, and the call wall at 440. And they do have NASDAQ levels, whether you're using the NQ or the QQQ. But again, these have much less weight to me. Options on futures, I mean, they are used and they do have their purpose, but they just don't hold the weight. But for the Qs and for the SPY, these levels are fantastic. And for the SPX, I mean, just must have levels. 380 call wall, 350 volatility trigger, zero gamma 359, put wall 345. All right, so everybody be careful, be safe.